All right, so today, welcome, by the way, we're going to be discussing raising capital for tech startups. All right, so raising capital for the inventor and the funder can be quite different. And so, what we wish to explore here are some of the aspects of the various types of funding that can represent or benefit both the inventor as well as your funding sources. Okay, so let's jump into it here. So some of the topics that we will be covering today in navigating the world of startup capital is debt and equity financing, advantages and disadvantages of each type, the impact each financing is likely to have in the relationships to your goals, and the recommendations I would have which type of financing to consider for your first and second round of funding. And last but not least, whether the recommended choice is suitable for the other entrepreneur, not just for the inventor. So before we begin into debt and equity finance, and let me just say that whether it is debt and equity finance, secure or unsecured, recourse or non-recourse financing, it all is going to entail at some point or in some part your own credit. So a lot of this is going to look at your own ability to repay debt. So I would first recommend kind of cleaning up your own house, and that if there is any deficiencies on your credit, write a letter of explanation regarding that. And that goes a long way with creating new partnerships or considering debt financing. With that said, let's move along. Debt financing. Debt financing involves the borrowing of money and paying it back with interest. The most common form of debt financing is a loan. Debt financing may consist of unsecured long-term loans from your shareholders, members, or partners. Equity financing involves selling a portion of the company's equity in return for capital. For example, the owner decides to give up 10% ownership in the company and sell it to an investor in return for that capital. That investor now owns 10% of the company and has a voice in all the business decisions going forward. So let's look at some of the various types of debt financing. You have bank loans, okay? There are three different types of bank loans. You have long-term loans in business, equipment, and unsecured loans. Secured loans in business equipment goes without saying, which is why it is which is why that fourth category of secured loans is not there. Business loans are intended for virtually any company goal. The loan may be provided for a specific purpose, such as onboarding new staff, or with no strings attached. Equipment loans are for more specific, used to buy, replace, or upgrade company assets. Secured loans requires collateral guaranteeing repayment in case of dissolution. It features a lower interest rate for easier repayment over time. Unsecured loans require any collateral, or they do not require any collateral, yet they can require an extensive financial assessment, including that credit, which I alluded to earlier. Featured debt financing option. I would recommend as a debt financing option is a recurring revenue lending, okay? Otherwise known as a software as a service credit. These funds, these type of funds are for companies as a function of their monthly recurring revenue. Your accessible amount changes based on the revenue garnered through customer subscriptions. So your monthly recurring revenue loans are structured as a line of credit that can be borrowed and paid back whenever needed. Additionally, companies aren't required to pay back interest if nothing is borrowed. These type of loans are for high margin, high growth businesses with a SaaS structure to rely on MRR financing to increase their cash runway or the length of time the business will remain solvent if they are unable to generate any additional revenue. Recurring revenue is highly attractive for companies seeking to finance rapid growth without adding more shareholders. That is recurring revenue lending. So what is the impact of recurring revenue lending? It provides highly flexible venture debt financing for growing SaaS companies. They build a relationship with you and your team to not only understand the platform you've built, but also your short and long-term goals. Taking this partnership approach to SaaS lending ensures that they're able to provide the most advantageous debt capital possible, while also providing insights, resources, guidance, and support as you progress on your growth journey. That is recurring revenue lending. Advantage and disadvantages of debt financing. Some of the advantages is that you won't give up business ownership, okay? It's not equity. There are great tax deductions. The debt can fuel your growth. Debt financing can save a small business big money, and long-term debt can eliminate reliance on expensive debt. The disadvantages of debt financing is that you must repay the lender. Even if your business goes bust, you still owe a promissory note to pay that debt. The rates are typically high with unsecured money, but if it's secured, that you can get a lower rate for that type of financing. And last but not least, like I said before, it does impact your credit rating when it comes to debt financing. The various types of equity financing. You have initial public offerings. These are for companies that are looking to go public, which is shares of a company are sold to institutional investors or to retail investors. Angel investors for equity financing. These are individuals who provide capital for a business or businesses startup, usually in exchange for a convertible debt or ownership equity. Venture capital, funds to startups, early stage and emerging companies that have been deemed to have high growth potential or which have demonstrated high growth. And last but not least, equity crowdfunding as a mechanism that enables broad groups of investors to fund startup companies and small businesses in return for that equity play. So the featured equity financing option that I'd like to discuss is our angel investors, okay? These are wealthy individuals or groups of individuals who invest their own money in startups or early stage small businesses. It enables entrepreneurs to get funding for the startup when they cannot obtain financing anywhere else. And it also does not require entrepreneurs to give up much equity in their company, meaning they can retain a large portion of their ownership. The impact of angel investors, being an accredited investors who identify small businesses with growth potential and use their own personal wealth to invest in them at very early stages, typically through an equity stake. Because the angels target new enterprises, they can serve dual roles as both the investors and mentors, bringing hands-on experience and guidance along with a financial investment. The advantages and disadvantages of equity financing. The advantages are it's flexible and risk-taking. No repayment or interest is required. They offer valuable knowledge, suitable source to get business going, and angel investors are in abundance, okay? Disadvantages of equity financing. They have higher expectations. They are investing their money and they're looking for a return on that investment. Future profit is limited because you're sharing it with the angels. You will lose some control over your business, but not to the, in minimal in comparison to other financing options or equity financing options. You don't, or you should not expect to receive any follow-up investment. Angel investments are typically looking for a return on their investment and they move on to other investments. So there is not a source where there are a second and third round of funding from the same suitable angel investors or investors. And last but not least, it may take longer to find a suitable angel investors. They are in abundance, but you may have to interview a couple just to make sure that they have the experience and knowledge that you seek to grow your tech company. Recommended financing options for first and second rounds. My recommended first option is angel investors, okay? You receive many of the financing benefits without giving up much equity in the company. Angel investors not only serve as a great funding source for upstart tech companies, they also serve as mentors and business connectors that can lead to future capital in venture capitalists and institutions. Your second round. Now, once you have your business as bringing in consistent profits via subscriptions, you can pledge those subscriptions as collateral and leverage a debt position. So your first round is conceived after your initial founders have already funded the business. Okay, so this goes beyond the initial investment to start the LLC. This is when you actually want to get the ball going and start generating business where more capital other than what the founding members have already provided is needed. Okay. Whether the recommended choice is suitable for the other entrepreneur. Goals of the tech inventor and a funder seeking an ROI can be quite different, as I mentioned earlier, and the approach in achieving both. The recommended options of funding creates a favorable position for not only the inventor in protecting your intellectual property and widespread usage, but also the funder's ability to leverage their investment with others without greatly compromising his or her equity position in the company. The options represent a win-win for both entrepreneurs, as neither must sign as a personal guarantor for financing or pledge personal assets as collateral. As the business grows, you want to consider your goals. You want to consider the various financing options, and you want to consider the importance of retaining ownership. Okay, that is going to vary greatly in choosing which direction you want to go when it comes to funding your tech startup. Also, like I said before, it does not go lightly to have a great relationship with your bank that you already have a relationship with. Again, working your credit if that's not already up to par, and a lot of these options will be open to you with all of its glory. So I hope this helps, and talk to you soon.